Hey everybody, it's me, the Einstein on Wall Street from the balcony here at the New York Stock Exchange. It is a beautiful day here in New York City. Not so much for the market. So markets go up, markets go down. That's just the nature of the beast, right? And everybody tends to get really scared. Look, think about the irrational enthusiasm we've seen over the market for the last year against all the odds of a recession and all the talk of the pundits about, soft landing, hard landing, inflation, interest rate story. The market forged on in an incredible bullish fashion that we have not seen since before the bubble of 2000. And I learned that little fact from Dan. In the 95, 96, 97, interest rates were at record highs and the market was super robust across the board. So we're coming out of 2023, which everyone said was going to be problematic. We closed up double digits. It was a really good year. We came into the first quarter of 2024 and we blew it out of the water. Out of the first 12 weeks, maybe 1 week was a bit of a pullback, but literally week after week, day after day, we closed at record highs across the board, NASDAQ, Dow, and the S&P 500 coming into the end of that quarter. We were up 10% on the S&P 500, the best first quarter of the year, let's be clear. It was the best first quarter of the year since 2019, and that was amazing. Now, markets go up, markets go down. We are in an environment where there's a lot of moving parts. I kind of think of it, it's like that 500-piece puzzle when you were a kid, and this is a 1,000-piece puzzle. Lots of moving parts, lots of components. We've got a couple of wars going on, right? As unfortunate as that is. We are in an interest rate environment and an inflation environment that's a bit skittish, right? Although the trajectory through 2023 was spectacular, since the beginning of the second quarter, since the beginning of 2024, we do have some PPI and CPI numbers that were a little hotter than people did expect. So the trajectory of 7 cuts down to 3 cuts, and now what we're going to start talking about with my buddy Dan Ives, the master tech analyst, #1 in the world, in my opinion, of Wedbush. We're going to talk about where we're at here in the first week of April, because things are changing. There's nothing but red on that screen. And the irrational enthusiasm coming into today, or 5 days ago, was green. Everything was green. Irrational enthusiasm, record highs across the board. So what has changed? Why are we where we're at today? We're down 500 plus points. The S&P is down 60 handles. CPI number did come out today. These are all the things that everything has been flipped on its side. Now, one day does not make a market, 1 week does not make a market. I'm here with my man, Dan Ives, tech analyst, master. Look, he's a man about town. He's a Renaissance man across the friggin' board, dressed to friggin' kill. We're gonna break it down, take all the intimidation out of the market, and talk about where we're at, what we can do about it, and what the future looks like.
Great to be here.
Always awesome to talk to you. So, this is probably the first. It's not a major pullback. It's not even a correction. It's a little bit of a slight pullback in many ways. We're down 500 points. It's probably the biggest sell-off we've seen for a couple of weeks, or maybe a couple of months even. And the CPI number did come out this morning. It was, and then you've got core inflation and you've got regular, right? And the CPI number came out a little hotter, 0.1% worse than expected, okay? And we've obviously got a war going on in the Middle East. There are a number of complications around oil production, oil delivery, and all that, and we're seeing a bit of a spike in that, and that goes to the core inflation story. But why are we selling off the way we are today, and what do you think's going on?
Look, I mean, market come into this year originally was pricing in 6 cuts from the Fed. It was, before today, pricing in 3 cuts. Correct. Now we're only pricing in 2. So a cut essentially has been taken out of the market and really priced in, which is why you see equity risk stocks, in terms of off. Look, I think the biggest thing is that January and February, the CPIs, they were viewed maybe anomalously. There were some one-time issues.
Right.
March was really the first, what I'll call clean CPI.
Right.
And it ticked up. In other words, like a 0.4, Street was looking for a 0.3.
Right.
It's a negative because, look, right now the Fed, they're neutral and everyone's waiting for them to cut.
Right.
But this essentially, from a data perspective, it's going to be longer for higher. And I think now you're going to see a Fed cut in June, kick down the road. What happens in July, potentially September, even November.
Right.
Then, to your point, it's a 1,000-piece puzzle with maybe like a patch on one eye. That's sort of the overall way I would view this market right now, in terms of trying to navigate it, especially from a macro perspective.
So the navigation, the observation, the perception of it all is with a patched eye. What does that really mean? So let's talk about it. So the numbers, we've come from 8% and change down to 3.1%, right? So the monetary policy that the Fed has put out by raising rates has done the trick, taking money out of the money supply to curb inflation that had run rampant as a function of the pandemic. Let's not get political. And so where we've come from to where we are now is really quite a spectacular move on the downside. But I think you described it. It's like, so if you go on a diet and you lose 30 pounds, your goal is 35. The first 30 pounds can be okay if you go on keto, on paleo, and you're really changing up your life and your eating habits. But the last 5 pounds tend to be problematic.
The hardest, and at the same time, you got oil that's ticking up.
Right.
You know, in terms of just the overall market, it's tight in terms of supply, rentals, insurance, things like that. Right. But my view is, look, when there's panic in the air,
right,
I view that as opportunity if you stay calm. So our view is, it's times like this that we look, especially in tech, who are the names we want to own going into earnings season. You get them 5-7% cheaper. I mean, look at NVIDIA. You know, NVIDIA correction territory. I view this not the time to, you know, sort of run for the elevator and scream fire in a crowded theater. It's a time to stay calm. Who are the names you own? And use this as an opportunity.
So think about that. So the VIX is spiking up, the fear index. We're talking about one day. Literally, we have not even seen a 1% pullback in this market for months and months. So today, due to the expectations around the CPI number, all eyes are on it. And obviously, we started to see dissent in the ranks with Bostich and with a couple other of the Fed governors early on in the week. Around Wednesday, we started to hear that the market was flattening out a little bit, that they did not feel like Jay Powell did to pay no attention to the hotter economic data that had come out in January and February. And they felt that maybe one, maybe two, or even maybe none cuts this year. I'm not sure if that's really good English, but it doesn't really matter. And the market, we saw that market sell off pretty hard on Wednesday around that thing. So what that made clear to me was that people's expectations are clear around the cuts. They're getting familiar with 3 cuts because Jake Powell kind of promised that, even though his decision making is always data-based. But he kind of laid it out there like a banana on a tailpipe there. He laid it out that we were going to have 3 cuts at his last meeting, 3 cuts, 75 basis points in 2024. The minute he laid that out, we've started to see dissent in the ranks. And for us as traders here on the floor, I don't know if it used to be different, but the fact that the Federal Reserve and its governors are not speaking out of one voice.